Ever get that feeling that Wall Street's speaking a secret language?
Mm-hmm.
Or maybe you've looked at a stock that just screams risky, but it also kind of whispers huge potential, and you're just left wondering, what's the real story there?
Yeah, happens all the time.
Okay, let's try and unpack this, because today we're going to take a deep dive into something pretty fundamental that affects how stocks perform: financial constraints.
Exactly. So in this deep dive, we're really zeroing in on the link between a company's limits in accessing funds and what you, as someone looking at the market, might expect in terms of returns.
Right.
And our main source for this is a research paper called Financially Constrained Stock Returns.
So our mission today is basically to cut through the jargon, understand this idea that feels a bit backward at first. Why companies that can't fully fund all the projects they want might actually be, well, riskier.
Mm-hmm.
And because of that, maybe offer higher rewards. We'll dig into what it really means to be financially constrained,
Yeah, what is that exactly?
how it's different from just being in financial trouble, and, the reasons behind this whole dynamic.
And the paper we're digging into uses a pretty complex model, actually. It looks at all sorts of things, like how much profit they reinvest, their debt levels, how costly it is to issue new stock,
Okay.
even things like how much their assets could be worth as collateral. It's trying to see how all these pieces fit together with stock returns.
Now, I know that might sound a bit academic,
It can, yeah.
but stick with us. We promise we're here to pull out the really interesting bits, the insights, and explain them in a way that just clicks. We're after those aha moments.
Absolutely. Understanding what makes the market tick.
Exactly. So let's dive in. First things first, what exactly do we mean by financial constraints?
Okay, so in this specific context, financial constraints are basically any hurdles stopping a company from getting all the money it needs for the investments it wants to make.
Hurdles, okay. Like what?
Well, think of it as limits on their access to capital. It could be difficulty borrowing money. Maybe they can't easily issue new shares of stock,
Right.
or they're super reliant on bank loans, or maybe some of their assets are hard to sell quickly for cash illiquid assets.
So it's about not having the funds readily available to jump on opportunities or expand.
Pretty much. It's
Yeah.
about funding those desired investments.
Now, you mentioned this earlier, and the paper really hammers this home. This is not the same as financial distress.
Oh, absolute vital distinction, yeah. Financial distress is when a company's incoming cash just isn't enough to cover its immediate bills.
Yeah.
Maybe they can't pay suppliers or they're facing loan defaults. That's crisis mode.
Right, immediate survival problems.
Exactly. But the paper we're looking at focuses specifically on the constraints, that inability to fund the investments they want to make, not necessarily the ones they need to make right now to survive. And what's interesting is even some studies that found like a negative link between company problems and returns, they often specifically exclude those distressed firms.
To isolate the constraint effect.
Precisely. To really focus on these underlying funding limitations, not the immediate danger of going under.
Right, so constraints are more about maybe hampered future growth because of funding issues, not about whether the lights will stay on next week. Got it. That's key. So with that clear definition, what's the central idea, the main argument this paper makes about these constrained companies and their stocks?
The core argument is pretty straightforward, actually. Companies facing tighter financial constraints are inherently riskier.
No.
And because they're riskier...
They should offer higher expected returns
Mhm.
to compensate investors for taking that risk.
Exactly. And the key to understanding why they're riskier, according to this model, lies in this concept of inflexibility.
Inflexibility. Okay, tell me more. What does that mean in this context?
Well, the model suggests that companies with, let's say, easier access to money, they have more flexibility in how they manage their big investments, especially when the economy goes through booms and busts.
Okay.
They can adjust how much they invest, and that acts like a sort of shock absorber for their dividend payments over time. Makes them smoother.
Can you, walk us through an example? Make it concrete.
Sure. So imagine there's a sudden positive economic shock, things are booming.
Right.
A company that's not constrained, that has easy access to funds, can quickly decide to invest more, maybe build a new factory, launch a new product line, take advantage of the boom.
Makes sense.
But doing that means some of the extra profit they're making gets reinvested right away. So the jump in their dividend payout might not be quite as huge because some cash is going into those investments. That investment acts as a buffer.
Okay, so it smooths things out. What about the constrained firm?
Well, the constrained firm lacks that flexibility. They want to invest more, maybe, but they can't easily get the funds. So they can't really buffer the economic shock with investment changes. Their dividend payouts are much more likely to just track the ups and downs of the economy directly, more volatile.
Ah, I see. So the constrained company's payouts are more like a direct line to the economic roller coaster, while the unconstrained one has some suspension.
That's a good way to put it. And that greater volatility, that closer link to the economic cycle, is what makes the firm seem riskier to investors.
Okay, got it. Now, the paper mentioned something called the shadow price of new debt. It sounds technical. What's the intuition there?
Yeah, it does sound a bit academic. But intuitively, the shadow price of new debt is basically the model's way of measuring how much those financial constraints are really biting. How binding are they?
How much they hurt?
Kind of. It represents the internal value, or maybe think of it as the hidden cost of not being able to borrow more money when you want to.
Okay.
Like if a company has a fantastic investment opportunity that could make loads of money, but they simply cannot get the financing. That missed opportunity has a cost, right?
That's right.
The potential profit they're leaving on the table. A higher shadow price just means that cost is higher, the constraints are more severe, the company has less wiggle room, less flexibility.
So high shadow price means more constrained, more inflexible, which leads to higher risk and therefore potentially higher expected returns. Okay, that chain of logic clicks.
Good.
But you mentioned earlier research, and the paper acknowledges this too. The evidence hasn't always pointed this way, has it? Some studies found the opposite.
That's a really important point, yeah. There's definitely conflicting evidence out there. Some earlier research, especially using an index developed by Kaplan and Zingales back in '97.
The KZ index.
That's the one.
Yeah.
Some studies using that index actually found that firms identified as more constrained sometimes had lower stock returns.
Lower. Okay, that's the opposite.
Right. But then other studies, often using a different measure called the Whited and Wu index, or WW index,
Right.
they often found a positive relationship, meaning more constrained firms had higher returns. Though sometimes that link wasn't statistically super strong, a bit fuzzy.
So yeah, a mixed bag. Kind of confusing for researchers, I bet.
Definitely a puzzle.
So how does this new model, one in this paper, help clear things up? How does it deal with these contradictions?
Well, the model helps reconcile these differences by providing that clear theoretical link we talked about, connecting financial constraints directly to risk through that inflexibility mechanism.
Ah, okay.
It gives a reason why constrained firms should be riskier. And with that framework, we can look at the real-world data, those mixed results, in a more nuanced way. It's not just about slapping a constrained label on a firm, but understanding the underlying dynamics.
Right, it's about the mechanism, provides the why. So, okay, what did the model actually predict when they ran simulations based on it?
The simulations gave some interesting results. When they did a simple analysis, just looking at constrained firms by themselves, univariate analysis, they call it, the model showed that firms with a higher shadow price of debt, the more constrained ones, did tend to have higher average returns. So that supports their main idea.
Great, aligns with the core argument. But then, I think you mentioned, when they started adding other factors, the picture changed a bit.
Exactly. Things got more nuanced. When they did a more complex analysis, multivariate controlling for other factors, especially the company's size, its market capitalization,
Yeah.
then the difference in average returns between the most constrained and the least constrained firms in the model became much smaller, often not even statistically significant anymore.
Whoa, okay. So controlling for size kind of washed out the constrained effect?
To some extent, yeah. And interestingly, that actually lines up with some of those real-world studies that also found the effect wasn't significant once you accounted for size.
That's fascinating.
Yeah.
Why would size make such a difference? Does it mean size is just, I don't know, a stronger driver of returns? Or maybe it captures the same risk?
Well, the model suggests it's not quite that simple, like one replacing the other. It suggests that risk and that shadow price of debt measuring constraints, they aren't determined in isolation.
Okay.
They're jointly determined, along with things like size and another factor called the book-to-market ratio, by deeper underlying economic forces affecting the firm.
So it's all tangled together.
Pretty much. The shadow price captures important info about these underlying drivers of risk and return, sure, but it's not entirely independent of the information that's already reflected in characteristics like size and book-to-market value.
Ah, okay. So it's like size and book to market might be acting as maybe easier to see signposts for some of the same underlying risks that the shadow price is also picking up, but more directly.
That's a great way to think about it. The shadow price gives us that direct measure of the constraint within the model, but out here in the real world, maybe size and book to market are the more readily available indicators that happen to correlate with those hidden constraints and risks.
That makes a lot of sense. Okay, shifting gears just slightly. What does the model tell us about which companies are more likely to be financially constrained? What characteristics usually lead to that higher shadow price of debt?
According to the model, yeah, several things tend to pop up. Firms that are more likely to be constrained typically have smaller capital bases.
Companies.
Yeah. Also, lower firm-specific productivity, basically. They're less profitable,
Okay.
and they tend to have higher levels of existing debt already on the books.
That all feels pretty intuitive, actually.
Right.
I mean, a smaller company probably has less internal cash flow,
Mm-hmm.
right? A less profitable one also has less money to reinvest, obviously. And if you already have a lot of debt, that's eating up your funds.
Exactly. It all contributes to what the paper calls a larger financial deficit, just a bigger gap between the investments they'd ideally like to make and the actual internal funds they have available.
So the bigger that gap, the more constrained they feel, the higher that shadow price.
That's the idea. And the researchers actually used their model like a test lab, a natural laboratory, they called it,
Cool.
to see how well those real-world measures we mentioned, the WW and KZ indices, actually capture this theoretical concept of constraint.
Oh, interesting. So they tested the test. What did they find? Did those indices hold up?
Well, the model showed that both the WW and the KZ indices do have a positive correlation with the model's shadow price. So when the shadow price goes up in the model, those indices tend to go up too.
Okay, so they are picking up something real, some signal related to constraints. That's good.
It is. They're not totally off base. But, and this is a big but,
Oh,
the model's analysis also showed that both indices explain only a pretty small fraction of the actual variation in the true level of financial constraints as measured by that shadow price.
how small is small?
The R-squared values, which kind of measure how much variation is explained, were mostly below 10%.
Wow, only 10%. So they're correlated, but they miss like 90% of the story.
Something like that, according to this model's perspective. So while they might point in the right general direction, these common tools seem to be capturing only a tiny slice of the real constraints companies face.
That is a huge caveat, really important for anyone actually trying to use those indices to pick stocks or something.
Absolutely. It casts some doubt on how much weight you should put on them as precise measures of constraint.
Did the model suggest one was maybe slightly better than the other?
Yeah, it hinted that the WW index might be a slightly better proxy than the KZ index, just based on the strength of the statistical link within their model. But still, neither explained very much.
Right, slightly better, but still not great.
Okay.
Let's pivot again. The paper also talks about leverage, debt levels and how this whole constraint and inflexibility idea gives us a new way to think about it.
Yes, this is another really interesting angle. So the standard view in finance, the traditional leverage hypothesis,
Mhm.
basically says that when a company takes on more debt, it makes the equity, the shares, riskier.
Yeah.
Because equity holders are last in line to get paid if things go bad.
Right, the residual claimants.
Yeah.
More debt, more risk for shareholders, so they demand higher returns. That's Finance 101.
Exactly. But this model adds another layer, another dimension to that.
How so?
The inflexibility mechanism we've been talking about suggests that higher leverage doesn't just make the equity riskier, it can actually increase the riskiness of the company's underlying assets or operations themselves.
And the assets themselves get riskier? How?
Because highly leveraged firms are just more likely to be financially constrained, right? We saw that earlier.
Okay.
And being constrained makes them less flexible, less able to adjust their investments or operations when the economy shifts or shocks happen. This reduced ability to respond makes their actual business operations inherently riskier.
Ah, so it's not just about who gets paid first if the company fails.
Right.
It's also about how having lots of debt can physically restrict the company's ability to navigate economic ups and downs, making those downs potentially worse.
Exactly. It hampers their ability to adapt. And because of this interaction, high debt leading to constraints, leading to inflexibility, leading to higher operating risk.
Yeah.
The model predicts that the relationship between market leverage and expected returns might not just be a straight line, it could be convex.
Convex.
Meaning the increase in expected return might actually accelerate as leverage gets really high. It's not just a steady linear increase like the basic theory suggests. That inflexibility risk really kicks in and amplifies things non-linearly at high debt levels.
Okay, wow. So for a company that's already heavily leveraged, adding even more debt could increase the expected return and the underlying risk by more than you'd expect.
That's the implication of the model, yeah. The constraints amplify the riskiness of high debt in this non-linear way. So, yeah, for someone looking at a highly leveraged company, this suggests the potential reward might be even higher, but maybe the downside risk from that inflexibility is also amplified.
That's a really, really insightful way to think about leverage beyond just the claim structure.
Yeah.
Super interesting. Okay, so let's try and bring it all together.
Yeah.
If you had to boil it down, what's the core message you'd want someone listening to take away from this deep dive?
I think the central message is that, yes, financial constraints can make a company riskier, mainly because they limit its ability to adapt and invest smoothly when the economy changes.
Right, that inflexibility.
Exactly. And this higher risk, at least theoretically, should translate into potentially higher expected returns for investors willing to bear it. However,
Always a however.
always, the big challenge is that accurately measuring these constraints out in the real world using the tools we commonly have seems pretty difficult. Those indices aren't perfect.
And it's absolutely crucial, as we stressed, to keep separating this idea of constraints not being able to fund desired projects from distress, being unable to pay your current bills. They seem to have different relationships with returns.
Precisely. Distress is usually bad news for returns, but constraints. It's more complex, potentially linked to higher risk and higher expected returns.
So this model gives us a useful framework, maybe, for thinking about how all these things, size, debt, those underlying constraints, interact to influence what we might expect from a stock.
Yeah, it adds nuance to our understanding.
So maybe the next time you see a company that seems a bit limited in its investments, it's not just being cautious. It could be a sign of this underlying constraint risk, this inflexibility.
Could be. It gives you another lens to look through.
And maybe explains why some seemingly stuck companies might still be interesting, albeit risky investments. It's like being strapped for cash can weirdly make you a bit of a wilder ride for investors.
It's a paradox, isn't it? But it definitely encourages us to look past just simple debt ratios and think more about a company's overall financial flexibility or lack thereof.
Absolutely. Well, this has been a genuinely illuminating look at financial constraints and stock returns. Thanks for helping unpack all that.
My pleasure. It's a fascinating area.
Hopefully, for everyone listening, next time you're looking at a company, you'll think not just about its debt, but about its wiggle room, its ability to adapt. Thanks for diving deep with us today.